Hello, everyone. Welcome back to our discussion of Chapter 3. As promised in Part 1, this is our discussion of things that are specifically in the tax law excluded from income, from gross income. So these are not shown on tax return literally anywhere, okay, because they are excluded, not included in gross income. So, first one that we want to talk about is fringe benefits. These are things that employers provide to employees that have been specifically said. Remember, whatever your employer pays you, no matter what form it takes, the general rule is that that is included in income. But these are areas and situations where the law is determined and the Congress is determined we're not going to include this in income. So, fringe benefits qualify, several fringe benefits, but they all have to meet the non-discrimination rules, which means you cannot provide them for some employees and not for other employees. You've got to do the same thing for everyone. And so one example of that is a no additional cost service provided to employees. And most of us are aware that airline employees get, if there are seats available on a flight, they can sign up and jump in that seat, what we call standby, space available, whatever, and go for mostly free. Okay, almost entirely free. Sometimes they have to pay some of the fees and sales taxes on the flight, but not the cost of the flight. I mean, that's a benefit. That's a income. You might say they're better off because they get to do that. Well, they determined that that didn't really take anything from the employer because they're flying anyway. So it provided no additional cost to the airline to put them in that seat. Now, of course, Congress had to put all kinds of restrictions on that, meaning I can't, only the airline company can provide airline seats for their employees. So a consulting company can't say, "Oh, we're going to buy tickets and put you on airplanes when we want," that for fun. Okay, they can fly you to something for a conference or for something business related, but they can't send you on vacation because that's not their business. Only the airline can do it on airlines. A hotel could give you hotel rooms. Company could not give you airline uh, seats. Okay, and airline seats can't give you hotel rooms. Now, a few years ago, some of the airlines bought hotel chains. I think partially for the idea of being able to provide both. And the IRS said, "Wait a minute. Yeah, those who work for the hotel part can have hotel rooms, and the ones for the airlines can do the airline, seats, but you can't. You can't mix them, even though you are owned by the same company." Okay, so that's the idea. Some other concepts, discounts. You often will have employee discounts. There's some limits, cannot exceed the gross profit percentage, meaning if I normally make 35% between what it costs me to buy the clothes and what I sell it for, I cannot give a discount to my employees below my cost. That's going to be a problem. That exceeds our what's allowed to be excluded from. But many people tell me that's one of the reasons why they go to work certain places for free meals or free discounted meals and discounted clothes, that sort of thing. These discounts are limited. If it's a service, it has 20% of the normal selling price. Your employer can provide you with certain transportation benefits. They can, in urban areas, they can provide a bus pass up to a certain amount per month. There are limits on all of these, as you can see, that for you to get to work. They can provide a parking space, again, up to a limit. Okay, if it's real expensive parking, it's going to be too much. So all of those are what's called qualified transportation benefits. Wouldn't some places are starting to use car share type of things, and those there's gonna, instead of bus passes, you parts of a car share, and the same idea. I assume that what will happen is the IRS will have limits on that the same way. Some other benefits are just been considered to be so small as to not matter. They can give you a turkey at Christmas. They can provide a picnic, and that's all benefit to the employees. But if they, again, don't discriminate, give them to everybody, everybody gets to go to the picnic, then it does not have to be added to their income. It's not part of their gross income. They can allow you to make copies on their internal copy machine. Um, the thing that's kind of changed recently is they can provide a cell phone, and if the original reason is because you need it for work, but you use it for personal use outside of work, that is considered a benefit you get to have, but is not included in income. For a while, employers were splitting it and all kinds of nonsense, and it was a big pain. And finally, the IRS just backed off and went along with the idea that it was a de minimis amount, because everybody has an unlimited plan. There's no such thing as very few places where there's a set number of minutes on your phone or anything like that, like it was back 15, 20 years ago. All right, so others that are specifically not part of income, with some limitations. Life insurance. I can provide a life insurance on my employees up to $50,000. Okay. The beneficiary cannot be the company. This is not for me to cover my butt if that person dies, if something happens to them. It's to help them provide insurance for their family. That's group term life insurance up to $50,000 is not included income. If I provide more than that, then I have to calculate in a fairly complicated way how much of the above $50,000 needs to be included in income. It's still a thing that employers will provide for employees even above the $50,000 and just included in income over that amount. They can provide educational system. You go take classes, they can reimburse you for those classes. They can pay your tuition up to $52.50 a year. They can pay back your student loans up to $52.50 a year. That doesn't even have to be related to your work, the schooling you got. Okay, that is a very broad one. Again, it has to be, you have to make it available for most everybody. Okay, but and you have that amount limit. Can't be more than that in a year. You can provide assistance to get child care or dependent care, however you want to look at it. Okay, $5,000, but it can't be more than earned income. So you can't do that if you're a fairly low-paid employee or don't work very part-time. So those are other not included in income, as long as you follow those limits. Again, employer. Employer wants to have these, they're going to have to set up a plan. They're going to have to write it so make sure that when the IRS challenges it, they can show that everybody had the opportunity. Not everybody has to do it, but it has to be available for everybody. So you don't have to make people go to school so that you can use that for everybody. You just need to offer it to everybody and then provide it for those who would take advantage of it. All right, other non-taxable incomes. These are most of the time non-taxable. The first one, almost all scholarships are not included in income. Fellowships start to run into, and that's usually for graduate school, because a fellowship often have a work requirement, meaning part of them paying for your school and all, maybe to help out is that you help out in a lab or you teach a class as a graduate student to undergraduates. As soon as you provide services for it, that's that part is income. So if the scholarship is just paid directly for your tuition or for your books and things like that, then it's not going to be included in income. Take money out of a qualified tuition program. That is something we have not talked about, but it's a way of saving for school. And when you pull that out later when the student is ready to go to school, that is not included in income. Someone passes away and you receive a life insurance payout. As long as it's a valid policy and everything is kosher, there's a very limited situation where it could be income, but almost all life insurance is not included in income. Grandma gives you a gift or inheritance, passes away and leaves you something. Those are not included in income. People get confused about that. That is not income to the receiver. There can be gift tax consequences. There can be inheritance tax consequences. But those are all on the giver, not on the receiver. All right, compensation for sickness, illness, injury is workers' comp is usually the most common one. That is not included in income. You have to be a little bit careful with that, but if you are compensated for sickness or injury, sometimes disability payments, or it depends on who paid the premiums, that sort of thing. Child support is not included in income. Welfare, food stamps, WIC, those things are not included in income. And employer-provided adoption assistance. Well, so they can set up a plan similar to the ones we talked about with education or child care, where they provide adoption assistance. That is also not included in income. All right, so review. Holiday turkeys are considered de minimis, so they are not included in gross income. Scholarships pay for only tuition fees, books, and supplies. Those are not taxable, not included in income. Remember, the only exceptions are fellowships, where there is a requirement that you do some work or provide services to the university for that. All right, some other more esoteric issues about included in income. Savings bond interest. There's specific savings bonds that are for education. Okay, this used to be a pretty good way to save for education. This is a really lousy way now because there's so many restrictions on it. But assuming that you did, and if you get the bond, you earn interest on the bond, it is not included in income to the extent that you pay qualified higher education expenses for you, your spouse, or dependent children. Here's one situation where it's important that we know who our dependents are. Okay, which ones are dependent, because you paid education expenses for a non-dependent, it would not qualify. Okay. If you have $15,000 of education expenses, you redeem your bond for $10,000, and you paid the $15,000, then obviously you paid it all toward the education expense, and therefore it's not included in income. If you have more income from the bond, more proceeds from the bond, then you have education expenses. It gets a little more complicated. You have to figure out the percentage that you used to cover education expenses, and that part would be not included in income. Now, this goes away. I told you there were lots of exceptions. If your income is too high, your AGI is higher than 145 on a joint return, and everybody else 96,800, that's not that high. And so you have to be aware of that's going to disappear, okay? And as your income gets higher, and therefore might not be as good a deal as what you thought when you bought the bonds in the first place. All right, so we have situations where someone might, and we mentioned this earlier, where someone might actually give you a loan and then forgive you the interest, or that's actually the next one, the gift loans, charge you an interest rate lower than it would be normal on that type of loan. That could be considered income. We don't worry about that if the for sale of property less than $30,000, and if the payments are all due in less than 6 months, not long enough to generate enough income and interest to worry about it. Okay, so some what you would call small enough to not matter issues, but generally, if you have a loan, a bona fide loan, real loan, not just a oh, here's some money for a while, but you actually have an agreement and everything, and there's should have been interest on it and not, you can still have interest income imputed on that. Gift loans, okay, where you, instead of having them pay the interest, you say to them, oh, I'll just gift it to you, okay? That is still imputed interest. It's still interest income, okay? But only if you're over $18,000 loan. So you got some wiggle room there. Then last concept is what we call OID, original issue discount. Idea with these bonds are you buy them, you invest them, you pay $75, and then when you redeem them, you get 100. So well, obviously, if you paid 75 and you get 100, then what you have is a bond that's paying you back the 75 and $25 of interest. Now, if it was a savings bond qualified, like we talked about earlier, then you could wait till the end and report all that income, all $25 at the end when you redeem it. Regular bonds, other bonds, not savings bonds, don't have that option. You have to calculate how much interest, even though you're not going to get it till the end, how much interest you earn for that year. And literally have to report it every year. Now, fortunately, most of your brokerage houses that you own these bonds through, Charles Schwab, E-Trade, any of those companies that you own are going to help you with these calculations for the most part if you buy these, and show you how much you have to report as income each year, making it a little easier than it would seem. But it is a fairly, you might say, a little crazy of a calculation. You can just calculate the interest on the amount you originally invested, and then each year that goes up because you add to it the interest from the years previous. You don't have to do this if it is a tax-exempt bond, like one from a local government or a state government. On U.S. savings bonds, we talked about those as separate. Okay, if it's less than a year, there's not going to be enough of a original issue discount to matter. Okay, and then we got this exception from clear back in 1984, which is a long time ago, and a non-business loan with $10,000 or less. So it's kind of a minimal amount of debt type of thing we're not going to worry about. So that's the issues with those things that can be excluded from income. So you notice there's not very many that are always excluded. There's almost always an exception. They're excluded except except when these things happen, or when the income is too high, then they're no longer excluded. So you have to be aware of not only the original rule, but also the exceptions.